Hello, chart watchers, and welcome to this Friday, December 14th, Market Watchers live show with your hosts, Tom Bowley and Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Not a good day so far in the market. Let's get into the numbers. Dow Jones Industrial Average currently down 445 points. The S&P 500 down 41. Not too far from that 2582 major support level established back in February of 2018. The NASDAQ down 103 points back below the 7,000 level. Russell 2000 down 8 points. It had bounced earlier in the session, tried to go positive. It is now starting to move back lower again. Like I said, down about 8.5 points right now. 10-year Treasury yield down 3 basis points, 2.88% as money rotates back into Treasuries. Volatility on the rise, up about 6.5% today. Leading to the downside, healthcare. Healthcare down 3.25%. Followed by technology, as you can see, down 1.77%. Energy down another 1.65% as crude oil has moved lower today as well. Leading to the downside for healthcare, no doubt, Johnson & Johnson. We'll talk about the story in a minute, but the stock is down about 10%, maybe a little over 10%. Costco and Adobe both moving lower after reporting earnings after the bell yesterday. Well, first, Mary Ellen, welcome back. It's always great to have you on here on Fridays. How are you doing today?
I'm doing well, thank you. Yes, trying to keep my bearings in light of another downwardly flashy Friday.
Yeah, I don't like this. I tell you, I have seen so many of my signals turn bearish. I was bullish throughout the year and convinced that we were in a correction, but a lot of things have turned. And I'm going to say really over the last 8 to 10 weeks is when a lot of it has turned. We've seen, of course, crude oil drop. We've seen small caps, the Russell 2000 fall off the right off the side of the earth. And then we've got transports, which have lost their earlier lows. I mean, the list goes on and on. We could talk about it for quite a while, but
just not as much fun.
No, it's not. It's not as much fun. I guess it's a little bit more fun if you see it coming and you move to the sidelines, but it's still no fun. I mean, I would, it's not good because it just starts changing the way everyone looks at everything. And then once all of these stocks start breaking down, and I know there are some out there that have held up really well. You look at companies like Microsoft and some of the software companies that have done well, but if we head into a bear market and other industries and other companies feel the effects, eventually it'll work its way back to those companies that are performing well. So
too true. Yeah, the last soldier standing, but unfortunately they too get whacked if we continue down here.
Yeah, and that's a big if, because I tell you, I'm standing right now about where I was in the beginning part of 2016, where it looked like everything was heading into the bear market, but we never lost the S&P 500 price support. And then all of a sudden we picked back up and moved higher. So, I think, we haven't lost that level, but with all the other signs that I'm seeing, I'm literally going to put like a 10% chance that the S&P 500 holds at 2582. I don't think it's going to happen, and I would not be shocked if it loses it this afternoon.
Oh boy. Yeah, and interesting you would bring up those dates. I'm going to be talking about that just a little in reviewing financials a bit later here, because that 14-15 period financials were just in the dumpster, and they managed to turn, and that's an area that we need that to come back to life before we can even think about getting bullish.
Yeah, the whole breakdown the banks and all that would just add to the laundry list of things that just hasn't looked very good. But I'll let you go ahead and go through our upcoming schedule and agenda, and we'll get this whole party started.
Oh my goodness, yes. So next week, another exciting week. On Tuesday, Erin is going to be doing her workshop. It's the building blocks for technical analysis, take everyone back to the basics. And then the next day, Danielle Shea from Simpler Trading is going to be joining Tom and Erin. That's on Wednesday. And then on Thursday, the eminable Julius DeKempener is going to be here. I'm sure he'll be talking about sector rotation and some variation of that. And that's next week. Today, we are going to be doing what's hot and what's not. That's coming up in about 15 minutes. And later, we're going to go ahead and do 10 in 10, where we're going to review. Tom's going to go ahead and give us his take on 10 stocks. He'll do that in 10 minutes. And then at the end here, we're going to be doing something different today. It's going to be, are you buying this? And we're going to be arguing the pros and cons of 4 different areas of the market as well as the stock. So stay around for that. That's going to be certainly compelling.
Yeah. Before I get into the economic news today, I got to ask you, what did you call Julius de Kempenaar? What was that name?
I don't remember, but he's just an expert, I guess, at sector.
Well, the word you used was helping me build my vocabulary, so you might have to listen back.
And it just flew right out of my brain. We'll have to listen to the rebroadcast.
It sounded really good. I mean, if I'm ever not here, you can use that same word for me. I don't even know what it was, but it sounded good. Anyway, let's go ahead and get going. We got the key economic reports out. We did have a few of those earlier in the session. Well, earlier this morning, I should say. You could see November retail sales came out this morning, and I know Mary Ellen's going to be talking about the retailers in a bit. A lot of trouble there in terms of the charts, but the actual numbers came out okay, not great. But retail sales, you can see, rose 0.2% in November. Market only expecting 0.1%. And then if we strip out the autos, we actually matched expectations in November, 0.2% rise versus the same expected. November industrial production and capacity utilization came out at about 9:15 this morning, just before the market opened. Industrial production very strong, 0.6% versus 0.3%, so doubled the estimates there. Capacity utilization right on target. And then finally at 10 a.m. this morning, October business inventories came out, and they also matched expectations, rising 0.6%. So all of that, you would think, hey, that's not bad news. I don't see any bad numbers on there. We should be looking maybe for money rotating out of the treasuries, right? We should see the yields moving up. Well, not so fast. We actually are seeing the 10-year treasury yield drop 3 basis points. We are down to 2.88%, and you can see this downtrend remains. A lot of things have been happening, and none of them really that good since we lost 3% support on the 10-year treasury yield. I would look back here to these other lows. I mean, I'm not excited that we're back here anyway at 2.70 to 2.75%, but that's going to be the next key zone or area for the 10-year treasury yield. And as long as we keep drifting lower in the yield, it means money is rotating into treasuries, and every dollar that goes into treasuries is a dollar that is defensive, thinking that the economy potentially is slowing ahead, or at least that the strength is not going to be what we thought it was. And what the Fed's been saying lately kind of, confirms that line of thinking. It was just about a month and a half ago, the Fed chair, Jerome Powell, said that we were not close to neutral yet on the rates and kept talking about rate hikes next year. 1 month later, he comes out and says, well, we're almost neutral. That to me tells me the Fed is backpedaling a little bit on what they're thinking about next year. We've seen a number of companies warn and lower guidance going forward, and this is kind of what the 10-year treasury yield is telling us. So you might listen to folks who are saying that things are fine and we're going higher, but there's a lot of signals right here that I think are providing some warnings, and we need to pay attention to those. Speaking of warnings, let's take a look at the earnings reports that came out last night. Start with Adobe Systems. $1.87 versus $1.88. They fell short on the bottom line. Costco, however, $1.67 versus $1.62. So not such a bad report there, at least on the bottom line. But let's go a little bit further. We'll look at the charts and also take a look at the guidance and so forth that was provided. So let's pull up first the Adobe chart. Adobe, as you can see, breaking down below recent lows on earnings. We did open above the support level, the short-term support level, but currently we're trading below. Very, very heavy volume. So I think it really matters where Adobe closes today. If somehow we could get back up and close above, say, 238 or so, I think we'd leave a long tail to the downside, and that would perhaps establish off of this top a right shoulder on this move to the downside. I call it an inverse head and shoulder pattern, where off of the top, you can see a move down to put in the left shoulder. Here's the neckline. Here's the lower low to put in the inverse head. Here's the right side of your neckline, almost equal. And then if we could put in a long tail here and hold, we essentially would be putting in our inverse right shoulder. So I would still be cautiously bullish Adobe if we could reverse and close back up over 238. Failure to do so, however, and I think we're going to head back to these recent lows. So it's going to be a big day for Adobe, heavy volume. Always you want to see what's going on when there's heavy volume like this. This is going to be off the charts kind of volume on Adobe today. Costco. And by the way, on Adobe, they did provide guidance, but I don't think it's comparable, at least what I saw, because they were including their guidance with their recent acquisition of Marketo. And so I'm not sure that it was comparable to what was out there. So I'm just going to follow the charts rather than try to figure out what's going on fundamentally there. Costco missed on their top line, $34.31 billion versus $34.66 billion. They did beat on the bottom line. I did not see guidance for Costco going forward, but I can tell you based on what's going on here, again, look at the very, very heavy volume. We're not even to the halfway point of the day yet, so this looks like it's going to be the highest volume day, at least over the last 6 months. And check out the area of support that we are losing. Like Adobe, we opened above the support level, so still open the possibility that door of possibility that maybe we get a reversal this afternoon. It would have to be a big one. Close back up above 217.5. Hold on to that closing support level with a long tail below, and that would be a really bullish development. But we're going to need to see it because, again, very heavy volume, and right now we've got a breakdown. And the reason these reversals are so important, when you look at a chart like this, I can tell you when I look at a chart like this, I'm not thinking about buying it. We got a triple bottom breakdown on massive volume. Last thing I would do is buy. So the only reason that we would get a big reversal here would be if market makers were trying to accumulate shares, maybe for some type of an institutional client that wants to buy. This is a great way to accumulate a lot of shares because everyone is getting stopped out that owns the stock, at least those that are trading in the short term. When you get this breakdown, their stops start getting triggered. And so one way to accumulate shares, if you're a market maker and you've got an institutional client that wants to buy, is to allow this breakdown to go and just simply buy everybody's shares while it's selling off. And then as you just buy throughout the day, you got a reversal, you come back up, hold support, and then the stock moves higher. It's a great way for market makers to build their relations with their clients because they get the stock so much cheaper. So keep an eye on Costco as we go throughout the rest of today. A couple other stocks to mention here. Starbucks outlined their growth agenda. They reiterated their fiscal year 19 targets. Unfortunately, their same-store sales were on the low end. They were saying it was going to be on the low end of Wall Street's estimates. So it's pulled back. I still like Costco. I think as long as Costco holds about $62, $63, I think this is a stock that can buck the trend and move higher. CNC, they reaffirmed guidance. This is a stock I think I mentioned in Under the Radar yesterday. They also announced a 2-for-1 stock split. I don't remember too many 2-for-1 stock splits recently. It seems like everybody likes their stock price to go up to 10,000 if it can. But anyway, they announced a 2-for-1 stock split, and the stock is down today. XPO, wow, logistics company. This is a company that yesterday had a short seller come out and basically say that the company wasn't worth anything near where they were trading, and that the head of the company was a crook. Essentially, I'm kind of paraphrasing here. But the firm came back and said today's report from a short-selling firm is intentionally misleading with significant inaccuracies and fails to reflect that XPO has delivered strong performance for its long-term shareholders. So I'm not going to read the whole quote, but obviously they're stepping up and supporting their company, which I would certainly expect them to do. And they also supported it in or by way of a $1 billion repurchase agreement of its common stock. So pretty strong reaction from management, from the shareholders, directors, so forth from XPO. You can see the stock now up 14% today. Last one I wanted to mention is Johnson & Johnson. There was a report that Johnson & Johnson knew of asbestos in baby powder, and you can see the stock is getting slammed. Earlier, I mentioned the XLV was underperforming, the worst performing sector. You can chalk it up, number one, to Johnson & Johnson. Massive volume sell-off. We'll see how this stock closes. So far, it took out prior low. We're seeing some buying coming back into the stock. Really needs to hold 132. That's an area I'd watch. All right, Mary Ellen, I know you've got some information for us on the retail group, which has been very, very weak of late. Some of these stocks have just literally falling off a cliff. What do you got?
Yeah, you bet. And so I'm going to be devoting this next section to taking a look at some of these retailers because the damage has just been really overwhelming in a sense. And so what I'm going to do here is go ahead and start by taking a look at XRT. This is the S&P Retail ETF. We're looking at a daily chart, but let's go ahead and pull up a weekly. You can get a better perspective here, and you'll see that there is continued deterioration. And retail really is an area of the markets that started selling off prior to the broader markets. It's an area that I certainly cover closely. There's a lot of high growth names in there that were really doing exceptionally well. And in September, we started to see some cracks in the on the surface. What we're looking at here is on StockCharts, that sector summary. And what I've gone ahead and done, of course, we can view all of the sectors here, and I've done it by a 1 month performance. And then going into the consumer discretionary, we can drill down and just take a look at the damage over the last month. This is apparel retailers down 15%, clothing and accessories 14%. I'm going to take us down and take a look at some of the individual stocks. And these are stocks that I'm quite familiar with. Again, it's an area of the market that I follow closely. And so this first company that we're taking a look at here is PLCE. This is Children's Place. We're looking at a daily. I'm going to go ahead and pull up a weekly again so we can get a little bit more in the way of perspective just how much damage has been done. It's down 7% this week. This is on the heels of a 20% drop last week. So the company really is just getting hammered. And the most perplexing thing, and the reason I'm bringing all of this to light, is this is a company that has a very superior management team in place. And even more importantly, the company did come out with strong Q3 earnings. They reported their earnings December 6th, so that would be last week. But the market just didn't like it. But the real problem here too is something that we're seeing with a lot of these retailers. They're coming in with super good third quarter numbers, earnings and sales are in place. They've, in fact, Children's Place grew their earnings by 20% year over year. Management is coming out and guiding lower for next year. This is what we're continuing to see with a lot of these companies. But PLCE has a lot going for it in the sense that their competitor Gymboree is closing 100 of their stores. They do have good channels and systems in place, but it's that outlook for next year that's really getting a lot of these companies just getting hammered. Let's take a look at another former winner here in the retail space. This is SFIX, and the company name is Stitch Fix. It's a newer issue here, but we can see it's down 23% this week. And this is another company that came out. They did come in with their earnings ahead of estimates. They reported their earnings last week, and they beat on earnings and sales. But again, management guide it lower going forward. They anticipated this is a subscription-based service where they provide you each month with, according to your taste, they provide you with clothing, and they are not anticipating any subscriber growth in Q4. So of course the markets came in and just slammed it. Some of the other areas that are hitting some of these retailers is the fact that Amazon did come out and they boosted their minimum wage to $15 an hour. And that's really putting the pressure on these retailers that have stores. We can take a look at another one. TLRD is the ticker symbol. This is Tailored Brands. And again, currently we're looking at a weekly, but the stock was down, I believe, 30% last week. And this is the parent company for Men's Warehouse. For those of you that know that particular company, it is a brick and mortar. So they are going to need to hire individuals at that higher rate due to Amazon, but they have other headwinds as well. Chinese tariffs, there's anticipation that the procurement of their goods, they're going to see increased pricing there. So a couple of other companies that we can quickly take a look at that are better known is Ross Stores, ROST is the ticker, and take a look at the damage here. You can see that the stock is really not doing well. This is another company that a lot of these retailers report later in the season. So these guys have reported within the last couple of weeks. So we can take a look here at Ross Stores and see really how the company, it's down 8% for the month, but it's down even further over the year. So this is another company that they came out, their sales met expectations, but again, they issued expectation for slow Q4 growth. And they're also citing labor expenses, transportation costs are up. Even though the company is due to double, they have 1,400 stores, they are going to be doubling the number of stores, but the street is still not liking it. And one last name we can take a look at, TJX. It's another discounter. It's a competitor to Ross. This is another one where they came out. They did, again, for this Q3, came out with exceptional earnings, but management guide it lower going forward. And the interesting thing is that consumer confidence remains at an historical high. It did dip a bit in November, and a lot of that reasoning or the thinking there is that consumers are a little nervous about the higher interest rate environment, and they're citing other headwinds for their consumer spending as it relates to income levels maybe slipping into next year. So a lot of these guys are really getting hit. We could really just keep going on and on. Yeah.
Yeah, I was just going to say, I mean, I see a lot of these companies, and I think what they're doing, you know, we had so much perfection priced into many of these retailers, and now all of a sudden things are changing, and we're seeing it not just in retail, but we're seeing it in terms of crude oil prices, which could be a reflection of slowing, you know, global economic demand. We've seen it in so many different areas of the market. You and I were talking about the banks before the show and so forth. There's a lot of different groups. So it seems to me like all of these stocks now that are starting to roll over is just another area of the market that's reflecting what we've been seeing in so many other parts of the market. Wouldn't you agree?
I think that's exactly right. And a lot of this is, for those of you that aren't familiar with the dynamics with as far as how the markets trade, they do tend to look out about 6 months, and that's anticipating a potential slowdown, not only in the economy, but here we're talking about consumer spending. And that is, as everyone knows, it's 2/3 of GDP is consumer spending. So it all kind of comes full circle.
Yeah, and I know, you know, you've been flashing through some of these other stocks. I mean, it probably should get going into the what's hot, what's not, but I would also add in, you know, I looked at, I think Tilly's, TLYS, Funko, FNKO. These were stocks that were absolutely on fire not that long ago, and they have completely just fallen off. You know, look at Tilly's there, 26 down to 10 or 10.
Yeah, absolutely getting decimated. This is that teen space that usually can be really quite resilient in to a slowdown in spending. And I know from prior periods, the teen space, they always seem to have slush fund, whether it's from their parents or babysitting. But yeah, even these teen retailers are such as Tilly's are really getting hit.
Yeah, they're getting hit hard. All right, well, let's go ahead and switch over to the what's hot and what's not, because I know you got a bunch of stocks that you want to cover there. I want to make sure we cover these stocks.
Okay, yeah,
and I just want to say that the market, by the way, and we talked about this last week, it's so volatile. I mean, what looks like, you know, it's having a pretty good week. All of a sudden, if you look at it 3 hours later, it's not having such a great week. So everyone needs to keep that in mind. But we did see some strength earlier this week in software. And I know you've got some names for us there. So what are those charts looking like?
Yeah, actually, you're right. Software within technology. So let's go ahead back, and I'm going to show you how you guys can capture this type of feeling as far as what's working and what's not, given the current markets. So we are looking at, again, that StockCharts sector view. This is a 1 week view, and we can see technology and communication services does have a number of tech stocks in it, Facebook and Google. These are your two top performers. They're not looking as well as they did certainly yesterday, but they are in positive territory for the week. So from here, we can just go ahead into the subsectors, and we can see that semiconductors and software are your two big drivers. Now, before I even go any further, I did dive into that semiconductor space, and I'll tell you, it's not an area I would wade into because the damage is just really full-fledged. And the few stocks in here that are doing well, they're just too far and few between. Software is an area that has a lot more in the way of vibrancy. It's a bit more spread out, so you can see some of these bigger moves. What I'm going to do is go ahead and drill down into some of the subsectors within software, and we can take a peek at some of these stocks. One of the bigger, better movers, if you will, is software, the database software. Data storage, the ability to not manipulate, but more importantly, really examine data and utilize it in decision making is a huge market. So here is a particularly good example. This is Tableau software. The ticker symbol is DATA. We're looking at a daily chart, and you can see this green line is your 10-day simple moving average, very much in an uptrend, and the stock is continuing to find support at that upward trending simple moving average. Your RSI in the top here is above this net neutral, trending positively. And take a look at this MACD, and you really wouldn't know what's going on in the broader markets to take a look at this. But I will tell you, and this is going to be true of several of the stocks that we're going to be reviewing, this company has triple-digit earnings, 488% year-over-year earnings growth. They reported back here in November. This is a daily price chart, but this gap up here is on that huge earnings, 500% above estimates, and analysts are raising estimates going into next year. The company is reporting this year, full year, minus 35 cents EPS, but next year, $1.62 per share. Huge growth here. So if the markets are able to hang in at all, this should continue to outperform. Here's another one that's also in this database software space. NEWR is the ticker symbol. The company is called New Relic. It's not quite as dynamic looking on the chart, simply because we're looking at a daily price chart, and we can see that the stock did get, it did sell off, but more recently, this is earnings related as well. The stock is finding support at these now upward trending shorter term moving average. Still has a hurdle here. It has to be able to gap up above this 200, but we can see the RSI is positive. Your MACD just entering into positive territory. This company is another one that reported in November, 433% year over year earnings growth, 60% above estimates. Analysts are raising their estimates going forward. So let's take a look at one other example, because we have other areas within software that I would like to get to. This is AYX is the ticker symbol, another triple-digit grower here, 300% year over year, 250% above analyst estimates. It's Alteryx, and again, same dynamics. We can see the beauty here is the stock has broken out of this base, poised to hit a new high in price. The stock's up to almost 3% today in a really difficult period. We can see the 10-day simple moving average in an uptrend, the stock finding support. RSI is positive, as is the MACD. So this certainly is a very, very compelling area in the markets. Let's go ahead and move over to software enterprise. And I know that Tom was talking about Adobe earlier, struggling a bit, but we can look at some other stocks that certainly through closed yesterday were outperforming. This is Twilio, TWLO, another big grower. Here's the company who came out with earnings here in November. So we can see this big gap up. The stock's RSI improved on that, and it stayed for the most part in positive territory. Again, we are obviously in a very difficult period here in the markets, but so for this stock to be able to withstand that is a real sign of relative strength. We can see this MACD is above this net neutral in positive territory. 200% earnings growth, 250% earnings surprise. So we do have commonality among these bigger, these stocks that are bucking the downtrend. And of course, that's going to be these big earnings. This is FIVN 59, and it's another stock that's holding up really remarkably well. Year over year, 350% on that earnings growth. RSI up here in positive territory, as is that MACD. We have time to take a look at one other. And by software enterprise, that in terminology means that they provide software where clients are ongoing once they subscribe to their service. It is enterprise, so that they have, these companies have consistent income, whether it's on a monthly or annual, depending on the subscription. So this is COUP, I believe it's COPA software, and not really quite as dynamic. It's still trying to form potentially the right side of the space, but we can see that the RSI is trending above that net neutral. MACD is going into positive territory. Again, super big, 260% earnings, 300+% above estimates. So all of these certainly, some of these software stocks are really just knocking it out of the park with their growth, not only currently, but analysts are continuing to revise estimates higher going into next year. And of course, that's what you'd like to see, if we can get that market backdrop to turn bullish, or we would certainly be more off to the races. So the next area in software, it's a continuation of last week, and that's software security. And these are companies that provide software that help corporations really defend against possible hacking. This is a company that's a little bit earlier in its potential turnaround. It's Palo Alto, PANW. So we are looking at a daily price chart. It's stumbling certainly today, unfortunately, falling back below that 50-day simple moving average, but your RSI is still a bit above that net neutral. MACD just poised to turn positive. And this was certainly a big winner here, recently reporting their earnings. It certainly has a little bit more in the way of work to do, but OKTA is the next one in this computer software security space. That is yet another one that you can see it's really withstanding downward pressures. It's flat on the day today, and your technical indicators are all flashing positively. So that is another area. I know Tom talked about Microsoft, and that really is a bellwether stock within this software space. We can just take a quick look at the stock, and you will see it's been bouncing around a bit here. It's a widely known name, so it will, unlike those other earlier software names that are really select as far as who is in them, this stock again is going to be a little bit more trading in line with the broader markets, but overall you can see that it's holding up remarkably well, certainly considering that some of those other areas such as retailers. I did want to spend just a little minute taking a look at some of these auto stocks. The China came out and they announced that they're going to be cutting their tariffs on US made cars. But I will tell you, not a lot of US auto stocks responded positively. The names I'm going to be sharing with you here are by and large foreign. The first one is Volkswagen, VWAGY. And for those of you that follow the markets closely, you may remember they have had huge difficulties here with their scandal relating to emissions. It's still a little dicey down here. You can see it's a bit bouncy. It's down with the broader markets today. They did come out, however, at the end of October. This is going to be this period here with really strong earnings, 165% year-over-year growth. The markets liked it. One of the other things potentially holding this stock up is the fact that they do have a 4% yield. We can see that the RSI is positive, but it's a bit more volatile, certainly than warranted given the current market environment. Let's take a look at a Chinese company. BYDDF is the ticker symbol. And this particular company, they manufacture electric vehicles, and it is Warren Buffett backed. He is a owns shares in the particular company, and they announced this week that they're going to be spinning off their electric battery. It's going to be an IPO, and the markets liked that, so we can see that the stock, again, given the overall general dynamics outside of this stock, it is holding up well, bounced off of this 200-day simple moving average. And we can certainly go ahead and move to another area that actually is fairly hot as well, and that's going to be your internet content space. I can go ahead and review certainly some of the better known names in this area. This first one is Twitter, and we can see how just really how well this particular stock is holding in this tough market environment. Another stock, MTCH. This is Match.com, and this is the online dating stock. It's a little bit earlier in its potential downtrend reversal. You can see the stock was a fairly big winner. This was a big earnings announcement. They also announced restructuring of their subscription base so that their higher revenues were expected. The markets liked it, but we can see how this stock really fell out of bed, primarily with the broader markets. This is their earnings release. They came out with good numbers, less than the market expected, so it did get hit. But more recently, it's been trying to come back and reverse this downtrend. We're still, again, in the early stages, but take a look at this RSI. It's turning positive here. We can see MACD is just poised. We had this positive signal crossover, the black line up through the red, and we can see it's poised to turn positive as well. I would need to see a bit more in the way of work, but the stock's up 3% today in this really tough market. So there are buyers in here that want to own this stock. These are institutions because we can see the bigger volume profile down here. So if we can break above this red 50-day simple moving average, we should be really in good standing. Let's take a look at another really well-known name that has very interestingly been trying to reverse its downtrend that started over the summer. This is Facebook. FB, of course, we're all tuned into that, but this is their big drop that occurred over the summer. They, of course, had that security breach, and ever since then, the stock has really been in a significant downtrend. But similar to that MTCH Match.com we just looked at, you're getting a sense that institutions and individuals as well want in on the stock, that perhaps it did get a little too cheap. Here we can see that it's attempting to reverse this downtrend. Your RSI is trending up here above this net neutral dashed, and then down here the MACD is just poised to turn positive. So here's another stock, if it gets up above that 50-day simple moving average is at 145, and the stock right now is just at that level. So if we can break above that 50, we could easily see a rally up to that 171 level, certainly all things being equal with the broader markets. But kind of interesting that we're seeing buyers. Facebook may have finally gotten cheap enough in here, and we do have time to take a look on this positive side at some of the consumer staples. And of course, it would make sense, given the nature of the broader markets, that we would see these more defensive consumer staple stocks, but not all areas are really doing well. This is Revlon. This particular stock did come out with their earnings. This is a daily view of the chart, and this gap up here in November was the company's release of their earnings, and they really did do really quite well. They came out with good numbers. Of course, it is still in that consumer space, even though it is viewed as a consumer staple stock. It is finding some pressure here, but more recently it does seem to be reversing a bit. So this could be a potential candidate within the consumer staple. Procter & Gamble is another stock that really held up well. Yesterday it was up over 3%. So a really stalwart, wonderful consumer staple stock that certainly, given the market dynamics, this one looks quite well. Take a look at this MACD. It's been up above this net neutral for quite some time, but we can see the black poised to go up above that red. So we could see another positive signal crossover as the stock continues to hit new highs, RSI trending upward. So with that, I am going to, I could of course devote an hour to the what's not hot area, but what I'm going to go ahead and do on the negative side is really focus on the areas that are getting hit the hardest this week. So certainly one of the first areas that we can take a look at is the financial stocks. And unfortunately, I mentioned this earlier, financial stocks are just having a really tough go of it, down another 3% following last week's significant decline. And again, this is not something you want to see. Generally speaking, financial health in the financial stocks is a signal that the economy is expanding, that consumer and corporate loan growth is there. But by looking at this chart, you're getting a sense that the street and the market is thinking otherwise. So let's go ahead within financials. I'm going to pull up an ETF. This is the regional banking ETF, and you can see that it's down 5%. And really, this is just an area that is not getting out of its own way. A lot of the initial deterioration occurred even before we saw the inverted yield curve, where shorter term interest rates for about a half a day were higher than long term, and that really spooked a lot of people. These banks, they make their profits on that spread between the difference between short and long term interest rates, and when that inverts, that is not what banks are going to benefit from. So let's take a look at some of these individual stocks within the financial space that are really getting hit. This is SIVB, and we can see that this stock continues to get hammered. And prior to this drop within these financial stocks, SIVB was far and away the highest growing, most widely viewed as being one of the better banking stocks out there. And you can tell just by this outperformance, relative outperformance. We're looking at a weekly price chart. So even prior to this year's market, you can see SIVB really did have quite a run, but it's going down with the ship, so to speak, even though the numbers are really quite exceptional for this particular stock. The outlook is really quite promising. They are on track to grow their earnings 81% this year. Analysts raising estimates for next year, but it really doesn't seem to matter. There's obviously, we can see by these big volume bars, the stock is under quite a bit in the way of distribution. Another similar situation, EWBC. This is another stock that the earnings profile isn't quite as big, but analysts are raising estimates up for this stock for both this year and next. But once we see, let's take a look at this particular EWBC is East West Bancorp. Again, a weekly price chart. So we can see the first breakdown here with this RSI trending below this net neutral. The stock breaks below. This green line is now a 10-week or a 50-day simple moving average. So once we get a break below that, that is your first sign that all is not well. We can see that the MACD also had a negative crossover in conjunction with that. So really, this distribution really seems to not be over quite yet, because we can see the volume is still coming in super heavy as this stock continues to decline. So financial stocks into the close yesterday are down 19% from their peak in price. And as you know, any drop below 20% is considered a bear market. So there's just really a lot that is not going well for these financials, even though their earnings profiles are quite strong. I mentioned that I would take a look at these financials relative. This is XLF, the financial ETF. And earlier we were talking about that 24 2016 period, and we can see that bank stocks, certainly with the rest of the market, but fell out of bed, but they were able to recover. So it'll be interesting to see just how low these financials can go before there's value seen and we start to see a turnaround similar to a Facebook or some of those other areas that are seemingly finding buyers and turning around. So we did talk already about some of these apparel, clothing type stocks that are getting hit this week. There are certainly other areas that we can look at, and one is the building area. Building stocks, whether it's construction that's heavy construction or not, what we can do here with StockCharts.com is go ahead and take a look at some of these areas within building that are really getting hit. So again, I'm going to take you back to that sector summary. And from here, we can go into the industrial sector. And this is going to also provide you with some intel as far as other areas within industrial. The transportation stocks are also getting hit this week. So what I've done is reverted this to a weekly view. So we can see that these heavy construction stocks are down almost 4%. And drilling in there, you will see a lot of other names. But let's take a look while we're in this industrial space at some of these transportation stocks that are continuing to get hit. This is a theme that we talked about last week because a deterioration in the transportation stocks is really foretelling. The Dow Jones theory talks about the Dow Jones Transportation Index as for instance. When you see a drop off in these delivery companies, these transportation companies, these companies are delivery services for products that are being sold. So when you see a drop in transportation stocks, it's with an anticipation of a contraction or a slowdown in the economy. So taking a look here at some of these delivery service stocks as an example, we can see FedEx is down 16%. This is a monthly view. UPS is very much in a similar position where the stock is deteriorating. And this is going into a holiday season that was expected to break records. So again, these stocks are really forward looking as far as anticipating next year. This is a 15.5% drop for the month on UPS. And let's go ahead back to that industrial area and I'll show you some of those other transportation type stocks that are getting hit. We can see rail stocks. Again, this is a 1 month performance view. The airlines, they were doing really quite well, but they too are getting hit. American Airlines is down this week. Delta Airlines, all of these are again with anticipation that consumers very well may be tightening their purse strings going into next year. This is a look at UAL, and actually it's up on the day. So, well, that'll be interesting to see if it's able to potentially reverse this downtrend. But we can see that these airline stocks are getting hit. American Airlines certainly looking even weaker than United Airlines. And then two, also within the negatives for this week, there are other areas that are getting hit, and they kind of make sense. Some of these staffing stocks, we can take a look at RHI is one of the bigger names here. This is Robert Half, and we can see that the stock is in fact getting hit. These are, again, companies that are going to be impacted if corporations do not continue to expand and grow. And of course, unemployment is currently at a 3.7%, which is a low that goes back to the 1960s. So certainly there's anticipation that we may have peaked as far as the need for these types of staffing stocks. So I'm going to go ahead and leave it at that because certainly within these negative areas, there's I can continue to go on as far as some of these home furnishers and jewelry, just a lot of these consumer related areas that are continuing to get hit. This is Tiffany's, and we can see that the stock, this is a weekly price chart. We can see that the RSI is really quite negative, and kind of interestingly, this is something you can keep an eye on. When the RSI gets below that 20, it's telling you that the stock is oversold. So it's with anticipation that at some point you'll get a bounce. It's certainly not that it can remain oversold for a period of time. What you're going to want to look for is this RSI to turn back up above that 20 and start to head north. You're going to want to marry that with a positive MACD as far as some of these stocks potentially finding a bottom. And that's something that we, of course, are going to be keeping an eye out for here over the near future, because a name such as Tiffany, certainly going from 137 down to 83, has really potentially been overdone to the downside.
Hey, Mary Ellen.
Mm-hmm.
First of all, take a breath, because you went through a ton of stocks in roughly 30 minutes, but appreciate that. But I've got two stocks I want you to pull up and tell me what you think, because these are two stocks that haven't necessarily just been weak for the last 5 trading days, but these are stocks that have been weak for a long time.
Mm-hmm.
And so first, of course, GE, General Electric.
Oh, yes. That's an interesting one.
They did get an analyst upgrade by an analyst who's been bearish on the stock for 2 years. The stock gapped up yesterday and then, started coming back down after that. You could see it's kind of reverting back to almost where it was. But do you see any hope for a stock like GE? I mean, is there some point or something that you look for that says, hey, I think, maybe the bottom is in here? Because I still can't find a bottom.
Yeah, that is actually a very good question, because certainly with the decimation that's been with this particular company, GE at $7, no one would have believed it going back certainly to 2017 and before. So what I would look for is, we kind of reviewed it a little bit with Facebook, but your first baby step did come into play. We're looking currently we're looking at a daily price chart. So yesterday we did get that first, what I call baby step, where it breaks up above, in this case, the 10-day simple moving average. And that's certainly constructive. Unfortunately, it is losing that today. It's down 2%. It did drop back below it. But ideally, if that were to continue, it would have a chance to rally up to that 50-day. But what you're not getting is the technical confirmation. So we do have this positive signal crossover, black line up through the red, but your MACD is still here down below the net neutral. And then the RSI is still below that net neutral as well. You want to see it get up a little bit higher, but this is that oversold condition that I talked about, and it can retain for some time. So we are getting a little bit of a bounce, but unfortunately we're not seeing that follow through, because ideally you want to have this advance eventually pull up these simple moving averages, because take a look at how this downward trending is 10-day simple moving average is acting as a ceiling every time the stock tries to rally. So you are going to need to see a really decisive break up above that to eventually pull this 10-day up, so that then it'll be liftoff, so to speak.
Yeah, I know when I see a stock like this, well, you don't see too many stocks like this, because it's a stock that has really gotten beaten up. I mean, it was beaten up even before this last 2-month drop. The stock was already down, I don't know how many percent, probably 50, 60% from its high a couple of years ago. But it almost feels like, to me, when you start to get a little bit of a deceleration in the selling, it's like, now instead of getting run over by an 18-wheeler, it's now a dump truck that's running over. It's a smaller truck. That's
a good analogy.
You're still getting hit by a truck.
Right.
And another one that's, it's maybe been a little slower and hasn't been in the, news as much, but look at Schlumberger, SLB.
Oh, yeah. Actually, I did mean to get into some of these energy stocks. I had a host of them, and yeah, Schlumberger, unfortunately, it's another one that just cannot get out of its own way. Now, I will just very quickly show you, like CVX, there are other areas within oil that are holding up a little better, but let's take a look at Schlumberger. This is, again, a daily price chart, and take a look at how long this stock has been in an oversold position, and talk about this downward trending simple moving average acting as resistance. Every time the stock tries to rally, hits its head on the 10-day, bounces down, down, down. Now, I will say today the stock's down another 5% for those intraday traders. I would argue that it's a bit overdone simply because of the position of the price relative to that 10-day. So you could see a little bit of a bounce, but certainly nothing sustainable. This stock that's really just looking at this volume. It's just continuing to get pounded.
Would you buy this?
No, no, but let me just show you what I was talking about. I'm going to pull up a 1 hour. I'm not going to have the right moving averages in place, but this is, well, nope, we're not even there, because even these, this is your RSI. You're still going to want these signals to be flashing positively. We're not there, so stay away.
Yeah, I don't care what size truck it is. I don't want it running me over, right?
It could be a little Volkswagen. You don't want it.
Yeah, well, when you were showing the CVX chart earlier, Chevron, of course.
Yes.
That one to me looked like you were only getting hit by like a 1979 Pinto.
Oh my gosh, the visual. Yeah. A lovely orange colored one.
Exactly. Still not good. I mean,
no.
Stocks are just not good. And crude oil price, of course, tumbling, not helping. But anyway, here we go. We got the summary for what's hot, what's not. We just have some of the areas that Mary Ellen covered, because we don't have room on the slide for all of the individual stocks. So it's amazing how many stocks you go through. But we certainly appreciate you coming on and going through all that. And it's not only the charts,
I enjoy it.
Great fundamental information, which is awesome.
Super.
Okay, let's go ahead. We're going to move on to the 10 in 10. And what I did today in coming up with stocks was, first of all, we're going to start with 3M, which was a stock that just looked somewhat interesting on the chart. So I'm going to go ahead and pull that up, and we'll start there. But the rest of the stocks, I went into the large cap scooters and took the 10 worst, well, 9 worst, to throw in there along with 3M. And so that's going to be the makeup of today's list. And just see, we were talking about so many of these stocks, especially like GE and Schlumberger getting hit. So we're going to take a look at some of the large caps that have very, very low scooters and just see technically if there's anything that looks worthwhile. So the first, and this one is not one of those, by the way. This is just another stock that was picked. But this is 3M. So let's take a look here. First of all, we got a downtrend. So that's the first thing I notice. And it's in a market that throughout 2018 was actually going higher. So this is not a good look to a chart when you consider what the overall market has done throughout the year. We have been putting in lower highs, lower lows. So we've got a clear downtrend in play. And I would say from a more intermediate term perspective, we've got overhead resistance around 216, 217. And then to the downside, we've got support down around 181, 182. But moving from a short-term perspective, you could see each time we've pulled back recently in the last month, we've been holding right at around 195. Stock's down more than 2% today, down to 197. But it would certainly seem to me like if it closes below 195, it's probably just a matter of time before we move back down and test that earlier low from late October, right at about that 181, 182 level. So not a big fan here with 3M, and short term, if that support's gone, I'd be careful.
All right. Well, your next name is Newfield Exploration. NFX is the ticker symbol.
Yeah, and these I looked at too, and it's going to give you a wide variety of different sectors and industry groups. So let's take a look at NFX, and you'll probably look at these charts and you'll say, yeah, I understand why the scooter rank is so low. Here's a stock that was trading at 30 2.5 months ago, and now it's down at 15. 50%. I mean, think about that for a second. Company's been around a long time, and they lose 50% of their market value in 3 months, 2.5 months. Pretty amazing and startling how fast some of these companies can lose their
luster.
Yeah, their luster and their valuations. But here was a big breakdown. We had the gap up, and this kind of move is similar, I guess, to what you were talking about earlier with GE, where we get some kind of a news, get a big bounce, everyone gets excited, and then same old. You just start rolling over and moving lower again. So I would say with NFX, at some point we'll probably bounce, maybe even get back up to that falling 20-day moving average, maybe a little bit more of extended strength. But This is not a good looking chart. A lot of big volume to the downside. So this is a type of stock that outside of trying to catch a falling knife for a quick little bounce, it's one that I would certainly avoid.
Great. And then the next one we did review, it's GE. You can take a closer look.
That's right. I forgot that that one was in there. Probably wouldn't even have brought that one up, but let's take a look. And there's that little pop, and you've seen a couple of these others where we've had a day or two. I think this moved back in November. I think this was when the new CEO said that he was going to be buying some shares. And so everyone got excited over that for a day, and you can see what happened after that. And then yesterday we had the announcement by the analyst who upgraded the stock from sell to neutral, who's been extremely bearish on the stock for the last 2 years, and he finally upgraded to neutral. A lot of folks got excited intraday, but once again, seems like the selling is moving back down. Now, you can see up here a PPO that has turned up, so we are seeing a positive divergence, but these are the types of positive divergences that I tend to ignore. And again, it's mostly just based on experience of watching these things. But a stock like this, what I like to see is a stock that bounces up, hits the 20-day, and is maybe a little bit more controlled in its selling. I mean, if you look at the volume here and compare it to what we have seen throughout the year, and this was not a light year volume, by the way. This was a pretty heavy year volume, and it really picked up in late October, and it has continued on a very, very strong pace throughout November and into December. The PPO, when it turns up, is telling you momentum is slowing. Well, when I look at the price action, I look at the volume coming into the stock, it's really hard for me to argue that momentum is slowing when you've got still massive volume, lots of distribution taking place in the stock. So I always say when that PPO gets down to minus 10 or even close to 7, 8, 10, that's telling you that the drop is so steep that it's going to be difficult to continue that kind of move to the downside. It doesn't mean that the stock is a great buy. It just means that it's gone down so fast that it's probably going to slow down in its move to the downside. And I think that's what we're seeing here. So I don't see anything yet on GE that would encourage me to go jumping in. So I'm going to pass on.
Yeah. Net analysts are lowering estimates, actually.
Yeah, and the other argument that a lot of people were trying to talk about with GE over the past year or two is every time it dropped, they would say, well, look at the yield, the yield. Well, they cut the dividend. So anybody hanging by that rope just took a big fall, because now what I think GE is a penny. Is it a penny now?
Yeah, it's I think it would have to be a 50% yield to.
Exactly. Yeah, and the other thing is
actually 6.7%.
It is?
That's what I'm showing, but it might not. My info might not be updated, so I will give you that.
I sworn they just they slashed their dividend down to a penny or something.
Oh my goodness!
Going forward, now maybe it's, I don't know if it's the past 4.
Their ex-div 12.19 could be.
Huh. Anyway, well, we'll have to look into that. But anyway, what we got next?
Oh, next one is Kors. KORS is the ticker symbol. Another retailer.
Another, I can only imagine. Yep, there you go. Ski slope. Another one that's got that positive divergence or slight positive divergence, that PPO trying to bottom. But again, very heavy volume moving to the downside. I think eventually the stock's probably going to recover, and I think the recovery could be a pretty decent one. I wouldn't be shocked at some point to see us maybe go. There was a huge gap down, reaction high around 50, and it's continued moving down. At some point, again, this was a $75 stock. At some point, we're going to rally. Question is, do you want to try to get in at 37 and see if we can get that rally back to 50 now, or will it go back down to 25 first before we start to rally? And that's always the tough thing with these down-sloping charts like this. So personally, I would avoid it. I'm not a big fan of Michael Kors.
WDC.
Yeah, this
Western
one is
Digital.
Yeah, this one is interesting because I'm going to come back to it, the chart here in just a second. But Western Digital, on a seasonality basis, when you look at 20 years, look at November, December, and January. Typically, we are in the sweet spot for Western Digital. When you look across the chart here, and you could even maybe throw in February and March. February was down, but March just has such a big move. I mean, November started a period where we tend to see a lot of strength in Western Digital. And yet we look at the chart, and here's November. I mean, this is where we were going into November. We're down about probably 8-10%, which isn't horrible considering what the market's done, but it's not showing those historical tendencies, that propensity to rise November, December, January, even through March. It hasn't started yet. But this is one, because of the seasonal tailwinds that it typically has. This is one that I might, try to keep an eye on, that if, maybe if we get some kind of a rally going, we start breaking out above moving averages, perhaps that would be a sign. Here you can see it did break down recently below October's low. It's got to get back up above 41 before it could even begin to sustain itself, I think, to the upside. And even then, I think you'd be probably in this area of this trading area between 41 and, say, 49 or so. So not yet looking great, but keep in mind this one does have strong seasonal trends over the course of the next couple months if somehow it were to, get itself turned around technically.
All right. Then we have another down and outer, NVIDIA, NVDA.
Yeah. The problem with a stock like NVIDIA, the company's a great company, but it's built on tremendous growth. And when you see a stock fall like this, I think it's just telling you the growth rate was way overblown. And now it's into a much slower growth, or maybe even, moving down for a while. I think you got to let this one catch its breath. It's one that I think will bounce back, probably like Netflix a decade ago. This is a stock that's just going to have to go through some pains here for a while. Short term, you could argue maybe that was an exhaustive gap off of this move to the downside. Here's your reaction high. So I'm going to draw another line right there. I think we are range bound at best right now in NVIDIA between those two levels.
COTY, another consumer name.
All right, COTY. Yeah, well, I think everybody's getting a flavor for how companies get really low scooter ratings, because this is just not better. Now this is a little bit of a lesson maybe in shorting, if shorting is your cup of tea, or if it's going to become your cup of tea if we do truly confirm that breakdown in the S&P. But here's a gap down. I'm assuming that was earnings related. Big gap down, heavy volume. Notice when we come back up, we hit the bottom of gap resistance. We don't go back and fill that gap all the way up here at 11. This was massive volume. There's a lot of sellers at 9.5. In this case, we get up to that declining 20-day moving average, right to gap resistance, and then make our way back down. I'm not liking it. That's going to be a major resistance area going forward at 9.5. And right now we're still continuing to trend lower. So not a fan of this one either.
All right. Next one is IPGP.
All right. Got three more here. IPGP. Well, this one actually gapped down. Could be exhaustive type of move, still holding that low. And ultimately that reaction went almost up to this gap resistance area. So let's just highlight those two levels. Because again, you've got a stock downtrending. There is your key resistance that we've got to get through before the character of this chart could change, in my view. There was a big volume gap down. I'm guessing earnings related, probably just another cockroach in the kitchen. As I like to say, that's one of my favorite sayings on Wall Street. Never just one cockroach in the kitchen. Usually when you get these breakdowns or you get something going on, something else happens again. It's another move down to trigger, another event to trigger a down move. But this is a nice candle off of that gap down. There's a lot of buyers coming in that drove this stock from 110 up to 140. After getting to gap resistance, we've turned back down. I think this is the trading range. I wouldn't do anything with it. We're in the middle of it. I suspect we'll go back down and test that 109, 110 area. At that point, you could put in on a fairly tight stop and maybe take a shot, but I'd wait at least until then.
Okay, and then Schlumberger, SLB.
Oh, that was another one.
Yeah.
Yep. Yeah, this will make for a pretty quick analysis. So, yeah, just, downtrend. You've got a easy down channel to spot right now. I mean, until this down channel were to break, I'm just going to kind of draw it in here. Something like that. And then you grab that, drag it over here. You kind of got that. And as you were saying, I think earlier, Mary Ellen, we're sold off so much, but even your shorter term intraday chart, you weren't seeing any kind of a buy signal where that trigger line had crossed over.
Surprisingly, yeah, it's down 5% again today.
Yep. I mean, it's just accelerating. And I mean, you could sit there and argue, and this is a perfect example of what I was talking about earlier. As we were moving lower in the second half of November, look at the PPO trying to rise higher. Technically, that's a positive divergence, but look what happened. We just kept going lower. I just be real careful about these positive divergences when you're selling off on massive volume, because they're really giving conflicting signals. The PPO is telling you that the momentum is slowing, price momentum is slowing, but the heavy volume and drops is telling you exactly the opposite, that there's a ton of sellers out there. So I don't think that this is a good positive divergence to look at. And now that we've broken down, you can see the PPO is now broken down again. Really just a mess here with Schlumberger. I'd wait. I think we got one more. Do we have one more?
Oh my goodness. Yes, of course we do. We can't leave without PVH.
All right, PVH, last one. And again, just another example of why these stocks have scooter ranks at about 0 to 1. Just nothing really to get excited about. The market's been throwing these stocks out for a while. If one thing this tells you is that when you start to break down and you start losing areas like this long-term sideways consolidation, and you start seeing lower lows, lower highs, it's no time to sit back and hope that your stock's going to go back up. Technically, when these stocks are broken, you should have stops in play and get the heck out of them before they continue doing this. This is what absolutely kills portfolios, holding on to these big losers. So not a good looking chart. A lot of work to do technically to start to repair the damage here, so I would stay away. So let's go ahead and just recap the 10 stocks that we just went over here, and then we will take a look, get a final update. But yeah, those are the 10, and there was just nothing. I don't know if you saw anything in there, Mary Ellen.
Nope, it was a pretty dismal list, I have to say. Nothing promising among them.
Yeah, I probably could have just done one and said all the other 9 look exactly like this chart. But
you were drilling the point home. That's what I'll say.
Okay, that sounds good. Sounds like a great illustration of what was going on there. It was an education moment, right?
That's it. Light bulb.
Yeah. All right, let's get into this final update, and then we're going to get into, are you buying this? And I know Mary Ellen will get her first argument ready while I'm going over this. But here you can see currently the Dow Jones Industrial Average down 386. So it is off the low, though. I think we talked about the top of the show. The S&P 500, 2615, down 35 points, but still pretty rough. And we still got almost 3 hours left in the day. So I'm not sure what's going to happen, but just watch that 2582 level on the S&P if things start to sell off again hard in the afternoon. NASDAQ down almost 100 points, down 94 and change. Russell 2000 down 10.5. 10-year Treasury yield still down a couple basis points, 2.89%. Volatility up 4.5% as the market sells off. Healthcare moving off the lows, and you can see over the last 4 or 5 weeks, we've had some pretty good support around 89. So that is at least encouraging that we're seeing healthcare bouncing from this level. Technology, though, continues under pressure along with energy. Johnson & Johnson, as we mentioned earlier, the report out that they knew that there was asbestos in baby powder. A lot of folks just selling first, asking questions later, although we do see some buyers, I don't know, maybe some aggressive buyers stepping in, hopefully looking for a bottom. Costco's broken down, no recovery there yet. And as you can see, Adobe also breaking down below recent lows. Not a good look to those two stocks after, at best, average earnings. And in the case of Costco, I think not so great. Anyhow, let's go ahead and move on to the Are You Buying This? And just a reminder for everyone that this segment is really about Mary Ellen and I arguing a point and then having the other come back and either saying we agree with it, so we are buying it, maybe not technically buying it, but we're buying the argument, or we're not. And so we can come back with a rebuttal and show our own charts or whatever. So hopefully you enjoy it. But Mary Ellen, what do you got?
Okay, yes, I'm going to go ahead and start with we're talking about going into next year. So this is a 1-year outlook. And I'm going to start with Tesla. And I think that Tesla, which currently is now, we're looking at a daily price chart, but the market cap for Tesla is at about 64 billion. And I think it's going to almost double over the next 12 months, maybe go up to 100. I'll say 100 billion in market cap. And here are the reasons why. Take a look at how positive and constructive the stock is now. That is because the company has really been on track with their Model 3 output, their production output. And over history has shown that over a 1 year period, about 100 million new vehicles are sold per year. So if Tesla were to get, let's say, 15% of that market share, and their cars sell at about $40,000 per car, that would potentially give them a 45 billion in net profits, which would help propel them higher. And the company did come out today. They actually cut their prices on cars after China came out with their tariff drop on US cars. Tesla's responded by lowering, which I think is only going to increase their sales. So I think this stock is going to be a winner going into over the next 12 months.
All right. That is a very good technical and fundamental explanation. And I am going to buy your argument. Mm-hmm. I agree with you. I'm not sure I'm going to say it's going to double. I think doubling might be a little bit, especially if the market overall is going down. I think that could certainly impact their forecast going forward and some of those things. But I'm looking at a weekly chart here on Tesla. And when I look at this chart, I see a stock that went up very rapidly from 180 to 380. So more than a double in about 7 months. And it had a tremendous market cap. And I think the numbers, it's trying to grow into its market cap. I could draw a line going across here. I think 380, 385 is really a big, big number for Tesla. And if it could break out, I think this is one that certainly could make a big move to the upside. I love the fact that when it sold off back in August, September, October, it went down to that April low and it held. So I think off of an uptrend, it's sideways consolidating, which I think is very constructive. I love these basing patterns when they finally break. And it's holding up really well considering what the overall market has been doing. So I would have to say that I agree with you. I think this is a stock that has room to go up higher. Mm-hmm. And again, I'm not going to say double, but I wouldn't be surprised based on this measurement right here. If it breaks out, I could see this being a 500, 525 stock. So I'm going to buy your argument. I like what you have, what you're selling. And so I'm going to.
Good call. Good choice, Tom.
I'm going to join you. Okay. All right, let's shift gears because now I'm going to show you what I'm looking at.
Okay.
And keep in mind first, I've been talking about this for a while, but here's the S&P 500, and this is where we're currently sitting. And you can see this week's intraday low was at 2583. Now, if I went to a daily chart, I could show you that the low back early February, we have not seen a close below 2582. I'm going out on a limb because I'm actually making an assumption that has not happened yet. But I believe the S&P 500 is going to break down based on all the other signals that I'm seeing right now. I hope I am wrong. I really do. I hope I'm wrong. But I think we're going to break down below 2582. And I think that the overall stock market is in a secular bull market, but I think we're about to go into a cyclical bear market that is going to be driven by this move to the downside in the S&P, which is going to confirm all these other signals that we have been seeing over the past 2 months. And as a result, over the next year, I think you could buy the SH, which is the ProShares short S&P 500. Here you can see it up trying to break out. If the S&P 500 goes down, you can make money by being in the SH. It is an inverse ETF. So you don't short this. You buy it. You put it in your account just like you were buying Tesla on the long side. But you make money in the SH on a pullback or a drop in the S&P 500. So I am going to say, Mary Ellen, that the S&P 500 is going to be lower in 2019, at the end of 2019, than it is right now. And I would buy the SH. And so looking a year out, are you buying this?
Well, I'm going to go ahead and take over the reins here, and we can take a look at the S&P 500 again on that daily and take a look at this recent low here. And I think that's what you're referencing, that 2382 level. And we can see that we've been able to be not undercut that recent low, which is even higher than going back to these February lows. And well, let's see. Can I okay. I actually believe you.
Oh, you do?
I do. I was going to try. I was going to, but I just think that there's just too much in the way of red flags. I was going to make the case for a single-digit S&P going into the next year, but today I have a tough time making that argument. So I'm good.
All right. So
I was going down there. If we were to do this, maybe in a week or two, and things were looking a bit more constructive. But
well, if anyone had made this argument to me prior to October, November, I would have disagreed with them.
Right.
And I think anybody who's listened to the show or read my blogs understands where I'm coming from. I mean, I've seen just too many signs under the surface, especially back in February. There was no way I felt like February was the start of a bear market. I actually wrote a couple of different blog articles about it back then. I mean, there was just too many bullish signals under the surface of the market.
True.
The only thing we had was a big pullback, and everybody overreacted. The market hadn't sold off in a long time. But this time, I think it's a lot different. But anyhow, let's keep moving on. So your next argument.
Oh, I'm next.
Mary Ellen, what do you got?
Okay, so I am predicting over the next 12 months, I think that we are going to see a move into the emerging markets. And let me go ahead and get a more relevant chart here. I'm going to pull up the daily on EEM is the ticker symbol. This is one of the largest ETFs for the emerging market space. It's the Morgan Stanley MSCI. So just taking a look at the chart, it's not that constructive, but there are other things to keep in mind when looking at emerging markets. And the first is this continued underperformance. And there is an argument out there that the smart money is flowing into the foreign markets, into these emerging markets, simply because the US markets are not holding very strong. So from November 1st to December 5th, there was 8.3 billion money flows into the emerging markets. The emerging markets, this ETF is now trading at 10 times earnings. That's compared to the developed markets, which are at 18 times. And the trade war ceasefire is good for these emerging markets. So if we continue to see well, the ceasefire, we'll certainly know more in April whether it sticks, but any kind of truce with the trade war is going to be constructive for these emerging market shares.
All right, so you would be a buyer of EEM for 2019.
You bet.
All right, this is where I got to disagree. I'm going to say I would not buy that. And the reason, this is a chart that I show on Market Watchers quite frequently, and it just simply shows, in this case, the U.S. 10-year Treasury yield versus the German 10-year Treasury yield. And when this is rising, it signals that our economy here in the U.S. is stronger than Germany. And the reason I use Germany and not any other place is that our markets seem to be more positively correlated than any other market that I've found around the world. So that's why I like to use these two. But when this is going higher, generally speaking, the dollar rises. And you can see down here on the bottom, this is a correlation factor that shows the 10-year Treasury yield here in the U.S. minus Germany, and then the U.S. dollar. And it compares the two, the direction of our two yields and the direction of the dollar. And you can see we stay primarily above zero. It's not a perfect correlation, but it's a pretty strong positive correlation. And so I'm looking right now, even though we have been pulling back on our yields here in the U.S. relative to Germany, I think the overall trend is still higher. I think the dollar is playing catch up right now. It has not hit that 2016 high. You can see that the 10-year Treasury yield relative, in U.S. versus Germany has moved to new highs, but this hasn't yet. I think the dollar continues strengthening. And so if the dollar continues to strengthen, I think that's going to really put a lot of pressure on the EEM. And I think you've got an underperformer there. So based on that, I'm going to disagree with you. I'm not buying it, but that's what makes a market. You got to take one side or the other. But all right, I'm going to switch over now. I'm going to give you one more.
Okay.
And this one is the relative strength of healthcare stocks versus the S&P 500 is going to be strong. I expect outperformance by the XLV versus the S&P. And I'm going to go back. This is a 20-year chart of the XLV relative to the S&P 500. I think I may have talked about this on Market Watchers Live. I know I put it in my blog article. But here, if you go back to the last two bear markets, end of 2000 through October of 2002, and then starting in October 2007 through the early part of 2009, the XLV wildly outperformed the S&P 500. And there's a couple of reasons for it. I mean, healthcare is viewed more defensively than some of the others. This doesn't mean, by the way, that healthcare went shooting through the roof. If you bought the XLV, you probably still lost money in both of these bear markets, but you don't lose as much as the S&P. So you're getting outperformance, even though it could go lower. I'm seeing the same thing developing, and I believe the S&P 500 is going to break down. So my argument to you is that over the course of the next year, we're going to have healthcare outperforming the S&P 500. What do you think?
I am going to buy that, and I'll tell you why. This is an argument, if you will, that I've had for a while here with healthcare. First of all, there is a defensive nature to the space simply because the medical services that are provided and a lot of the drugs, they're still going to be needed despite any kind of potential slowdown in the economy. You're still going to need those medications and those medical services that are being provided. And the other reason is with the recent midterm election and divided Congress, they're not going to be able to attack Obamacare. And that's been really quite constructive for some of these hospital stocks, home health care. They're not going to be impacted. Government spending still goes on, even if an economy slows down. And a lot of those healthcare providers is another area. They are dependent upon a continued flow of federal funds. And I think that's going to continue into the next 12 months. So I'm going to buy your argument or your.
So we got 3 out of 4 that we bought. We'll go ahead and show that summary slide. And then the poll that we set up today, and we're going to jump into that here in just a second. But that poll is kind of lines up with what we were talking about here. So we gave you an opportunity maybe to take a look ahead of time before we got into this little friendly debate that we had. And so you all, which of the following stocks and or ETFs would you buy given a 1-year time horizon? That wasn't exactly true. We were trying to figure out how to put that first one up there because I do think the XLV could go lower, but I think on it from an outperformance standpoint, I personally think it'll be there, but that one was chosen. But outside of that, we got none of the above, 29%. And Tesla, look at that, only 3%. I
guess they don't like Elon Musk. That's what I'm going to say. It's not our arguments.
I would agree with that argument too. If you had said that Elon Musk is a wild card, I would say yes, I agree 100%. I do think he is a wild card. I think he's a nut, to be honest with you. But looking at the chart, and technically, I think you made a really great argument with Tesla, both fundamental.
Yeah. The earnings, I didn't even get into that. They're going from negative $1.30 per share this year to $6.30 per share next year. So the prospects there are certainly in the cards.
Yeah, give me a Warren Buffett in charge of Tesla, and then
there you go.
Doubling. I'm going to double all in. Anyhow, all right. Well, we're getting closer and closer to the end of the show. I will just quickly tell you that, let's see, we got the Dow Jones right now back down a little over 400 points, 412 this afternoon. I don't know how you feel about this, Mary Ellen, but I'm a little nervous. I mean, we've got about 45 seconds here, but what do you think as we end the week here? You know, normally second half of December strong. What do you think as we go into second half?
It's a bit unnerving. I think I did a show earlier with Aaron, and we asked, do people think that we're going to see a Santa Claus rally? And the consensus, and that was just 2 days ago, was, yep, it very well could be in the cards. But the dynamics more recently are just getting too ominous to look the other way, so to speak. And the thing where I'm not sure if we're getting a lot in the way of volume. I mean, I'm really stretching here to try and find potential bright spots. But when you see some of these small caps and other areas just unable to get off the mat, we gotta wrap up.
I'm sorry, I don't mean to cut you
off.
Nope,
sorry,
but I do want to say Santa's dressed in red, so keep that in mind. Okay. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Be careful out there. Be safe. We'll see you on Monday. Happy trading.